Hello everybody and welcome back. Welcome back to lesson 16 on market analysis. Spent a lot of time on stock specific stuff up till this point and actually on writing your trading plan. What we're going to discuss here now in a very general term is how to actually define the market. Now everybody kind of gives the word quote unquote market a broad stroke, for lack of a better way of putting it, and what we're going to do here is put a little more of a clean spin on specifically what to monitor while you are watching the market. Standard disclaimer here. All right, the goals for this lesson: define specifically what the market means. And again, I have market in parentheses, very specifically. We're going to break that down a little bit. Number two, thoughts for using market analysis in conjunction with your stock selection. A lot of what I talk about, especially in the peak performance section, is understanding how to trade with conviction. And ultimately, trading conviction means that you have built a really solid argument for your idea. And that's where confidence comes from, because you have conviction in your strategy, your tactics entering in the direction of that strategy. And that's more of the stock specific area of it. Adding the market to what you do in your stock specific selections will help increase your conviction. That's what you want to write down there. We're also going to discuss Dow theory. Quite a few people discuss Dow theory. It's on television quite a bit, but a lot of people really don't understand what it is and, more importantly, how to use it. That's obviously the most important thing. Having a tool and not understanding how to use it, very, very different. So understanding where it is in the current stage of price action in relation to Dow theory. And learn two very specific price action conditions, and this is the important part here, to determine the probability of the next market move at new highs or new lows. That's actually a pretty significant comment there. All right, so defining quote unquote the market. When someone refers to the market, they're usually referring to the major indices. Now, it's very common today. There's the Dow Jones, there's the diamonds, there's inverse ETFs, there's everything all over the place. Whichever you choose to use, I'm going to be very clear on this, whichever one you personally choose to use, keep it consistent all the time. So in other words, what I'm saying is, don't one day use the Dow Jones Industrial Average and the next day use the diamonds and the next day use the Dow Futures. Stick to the one that you use consistently, because those significant reference points will matter the most to you. Some people just use the cash indices. Nothing wrong with that. I, on a daily basis, usually use the spiders, SPY, because a lot of the students that I work with do not subscribe to futures markets. So it's very simple and very easy to just speak to everybody in reference to using the ETF of the spiders, which is the proxy for the S&P 500. Whichever one you use, be consistent. So the indices tell us the approximate strength or weakness of the environment we're trading in. Now, I want to touch on that for a second, because I know I mentioned this in previous lessons. I purposely put approximate in there. The approximate strength or weakness of the environment we're trading in. Market leaders will always move prior to the market indices. I want you to write that down. Market leaders, or high beta stocks, however you want to word it, will always move prior to the market moving. So you need to know which stocks those are, whichever stocks are leading the market at that particular time in that particular economic cycle. Now, I don't want to go through them here because I don't want to date the material. So do a little research on your own and figure out, again, I'll just go back 10 years ago. Tech stocks 10 years ago, early 2000s, were obviously the market leaders, and those were the ones that controlled the market, for lack of a better way of putting it. So there was Cisco, Microsoft, going back into that, Oracle at that time. Right now, those stocks are really not market leaders or beta stocks actually anymore. They're really more mature companies. They're not leading anything right now. They're just a part of the market. All right, so Dow theory as part of defining the market. As we have here, the indices discount everything. It's essentially excuse me, a consensus of opinion expressed with money invested in the market. The point that I want to make here, don't discount the value of the numbers themselves. In other words, that indice or ETF, or whichever way you decide to look at it, is actual money committed on a much broader scale. So what we're really talking about here, if we're going to define it in a little deeper, what we're talking about right now is the broad market. Okay, a broad bull market, a broad bear market, or nothing. going on for that matter. So we talk about the market, excuse me, the market discounts all of the news. That's the point that I want to get to. I actually wrote discount everything. I should have probably put in there the market discounts the news. Very important. All right, last but not least on the slide, to the experienced trader, the major indices will show direction and the strength of those opinions that are being discounted by the expression of money in the market. Now, the point that I want to make here, I wrote experienced trader there for a reason. Experienced traders will consciously add the market environment to their trade expectation. I want to make that very clear to you. It's one thing to look at it and say, oh yeah, whatever, the Dow's up. Oh yeah, whatever, NASDAQ's down. Oh yeah, whatever, the SP's doing. Literally use it to adjust your trade expectation if it's obvious. So in other words, if you want to be long a stock, or you are long a stock, and the broad-based market is obvious in the direction of your idea, your trade expectation should increase. So what I can't get across to you here, as we covered in the trade expectation audio, the bottom of that pyramid to help build your argument, to have conviction in an idea, is what is the broad market doing? And that's what we're talking about right now. So the whole point of what I'm getting across here, an experienced trader will literally weigh or gauge or analyze what the market is doing if it's in sync with your stock-specific idea, and that will increase or decrease your expectation for follow-through on your idea. And if you want to go back to that audio, you understand what I mean more about trade expectation. All right, so we're talking about the three major indices that compose, again, the general market or the broad market. First, we're talking about the Dow Jones. Now, again, I wrote it consists of 30 of the largest and most widely held companies. This mattered 30, 40 years ago. Okay, now it is, again, I'm going to preface that. It's an extraordinarily popular gauge. However, the world is much, much more global now than it ever was. 30 stocks are not enough to get a real solid gauge of the economy, which is why most bigger traders spend a great deal of time on what the S&P 500 is doing. The 500 stocks are a much better gauge of a broad-based representation of the entire market. Next, we have the NASDAQ index of well over 4,000. Again, that could fluctuate up or down from there, but mostly technology and fast growth companies. There's different listing requirements for NASDAQ compared to the Dow Jones, which is not only listed stocks from New York Stock Exchange, but there's a little bit more company history behind stocks that end up in the Dow as opposed to the NASDAQ composite. And last but not least, obviously the S&P 500, whether you use the SPX, the SPY, the futures, it's completely up to you. I just find that using the spiders, you can get some arguments, well, the futures move faster. Okay, so you got a 10-second head start. Big deal. It all depends on your time frame for trading. But the bottom line is, again, whichever one you use, put all three of these in context. If you choose to use the spiders, use the diamonds and the Qs. If you choose to use the Dow Jones Industrial Average, then use the indexes. Don't use one of the Dow Jones Industrial Average, one of the NASDAQ futures, and one ETF, okay? So when you compose the market, you must use all three of these in conjunction with each other, not just one. That's the point that I want to make here, and we're going to get into that in a little bit. All right, so analyzing all of those with a purpose. The odds for success, your odds for success, increase dramatically when you're on the same side of the market, when your ideas and scenarios are on the same side of the market. So how do you use that with the trade idea? Here's the bottom line. You always want to have stock-specific ideas. However, better stock-specific ideas are those ideas that are in the same direction of the overall market at the same time. So the first thing you want to do is you want to kind of glance over at the market on a intraday and day-by-day basis and take a look and see, is the market obvious right now? If the market is obvious, then the best ideas that will have the highest expectation for follow-through will be those same ideas that are trading in sync with the market. So again, I didn't say you will definitely make money. I said your odds for success will increase. Okay, so that's all trading is. All of trading is about probabilities and managing risk. Market analysis between those three different components of how we define the broad market will and should increase your success for follow-through. Doesn't mean you'll be a great trader. What we're doing here is setting up the probability and increasing the probability. So the best and only way to get a feel is to literally monitor volume and price action on a day-by-day basis. And that's even if you're holding trades long-term. You still should monitor what the market is doing, what significant reference points are coming up, whether there was less or bigger volume on particular types of days. So obviously on a big day to the upside or the downside, you want to look at whether what's called an accumulation or distribution day. We spent some time in previous lessons talking about accumulation and distribution on a longer term basis during a consolidation. Now we're actually getting into a little bit more minutia on a day-by-day basis. So it's very important to monitor all of those. So the goals that you're going to have for market analysis are quite simply: determine the trend, the strength of the trend, significant support and resistance levels, and momentum. And momentum can very clearly be defined as the last 2 to 6 candlesticks in a particular direction. Last but not least, you want to recognize through price action and the market internals, which is the VIX, the TRIN, the TIX, etc., 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 when that trend may be losing momentum, when it's reversed, and when it should follow through. And that's a lot. Think about that. Just one little sentence, okay? Price action, market internals, losing momentum, reversing, and following through. Think about that. If you can add all 5 of those elements as a part of the argument for what you feel your individual stock is going to do, now you're starting to think like a professional. All right, Dow theory. What exactly is Dow theory? To back up 1 second, it's actually not on the slide here. Dow theory, a part of it that's not on the slide here, basically said that at any one time there's always 3 trends occurring. There's the long-term bull or bear market, there's the intermediate-term trend as technically defined in Dow theory, and then there's the minor price fluctuations. And that's why a lot of traders use multiple time frame analysis. It's kind of Dow theory on whatever time frame they're looking at. You want the longer time frame for your trend, the intermediate time frame to help you time it, and then you have the shorter time frame fluctuations. So as it was written in 1932, the movements of the railroad and industrial stock averages should always be considered together. Clearly, we're not looking at the railroad stocks right now. So we actually have extended it out a little bit. The movement of one price average must be confirmed. That's the part you want to write down or highlight there. Confirmed by the other before reliable analysis may be drawn. That's very important here. Confirmed and reliable. And we're going to discuss, we've already discussed actually, we're going to get into a little more detail about how to use those. Now this is, again, very, very important. I keep saying this because this is a lot of stuff in this one little chapter here. Conclusions based upon the movement of one average, unconfirmed by the other, are almost certainly to be misleading. Now, why is that the case? Think about this. What you want to get across to yourself, all of the volume that's being traded in the broad market at one particular time, if that market is having an argument, meaning the Dow, the S&P, and the NASDAQ are all not in sync, the reading you get from one, more often than not, will be misleading. So if you take those 2 bullet points, must be confirmed, reliable, unconfirmed, misleading. It's very important that you go over this tape and this particular slide, pause it, and write the stuff down. Now, the market's changed dramatically, obviously, since 1932, but the principles are the same. So we're not using, as I said, the railroad and the industrial averages. What we are using, as we've already mentioned, Dow theory absolutely still works. But because of the volume, the complexity of the global market now, we're using the NASDAQ, the S&P, and the Dow all at the same time. And we're going to talk about how to do that. So what are the 2 special market scenarios that we're going to talk about in relation to Dow theory? One of the biggest mistakes a trader can make in today's equity markets is to draw a conclusion based upon just one average. So even if you're trading only NASDAQ stocks, you should still watch the Dow and the S&P in addition to watching the NASDAQ. That's the point that I want to make here. All right, actually, I got ahead of myself. So if you're trading NASDAQ, don't only watch the NASDAQ. You want to watch the NASDAQ, the S&P, and the Dow. But more importantly, we're going to discuss how to watch them. So what you want to think about is here is your idea is being supported or not supported by the broad market. That's the point that I want you to write down and put on a post-it pad. Is my idea, my stock-specific idea, being supported by the market with all three legs of the broad market, as we call here, stool. All right? If they're all working together, you can trust the stool. You could sit on it without worrying about falling down and confirm your idea or increase the probability for your idea. If one of the legs is not cooperating, it's very difficult to expect for it to follow through, which is what we actually said is one of the goals at the beginning of the chapter here, because all that volume is not doing the same thing. So there's kind of like a little tug of war. So you don't expect to get those big green or big red candles because all the volume's not on the same page. So we started the chapter talking about the huge volume in the market, the global market that we're in the market. So we want to know if all that volume is on the same page or if it's not. Now again, I want to make very clear here. It does not mean to not trade your stock-specific idea. That's not what it means. You can still trade your stock-specific idea. What we're talking about here is increasing the trade expectation if this circumstance where they are in sync is present. You increase your trade expectation for follow-through. That's the point to take out of this. Very, very important. All right, so what we're monitoring for here on a short-term basis, and this also works on longer-term daily and weekly charts, and it's essentially looking at significant reference points. I'm going to talk about the most recent ones here that we watch on a day-by-day basis, but you can extrapolate it out to daily and weekly charts. So the price action for a short-term active trader like myself is we're monitoring for 2-day highs and 2-day lows. So in other words, you have yesterday's price action and today's price action as it's unfolding to make it very, very clear. So what we're looking for is today's high and low and the previous trading day's high and low. So both of those. So as the market opens, you're looking at today's market action compared to yesterday's high and low. And then as the market's unfolding during the day, you're going to use both today's high and low and yesterday's high and low. So what are we looking for? Are the three indices making new intraday highs or lows together? Are the three indices making new 2-day highs or lows together? Now, the interesting thing here is, you'll be like, people are like, oh my God, how the heck am I supposed to watch that all day? Come on, there's so much software available right now where any software can set up. If one of the three indices is making a new high, all you do is look at the other two. It's that simple. It's literally that simple. It should flash on your screen and say, boom, Spider's making new highs, or whatever, the Dow's making new highs. Just look at the other two. It's that simple. Have three little charts sitting next to each other and just glance over at them. It takes all of a second to pay attention. All right? And last but not least, if they're not hitting these levels at the same time, in other words, today's high or low or yesterday's high or low, how do we use that information? So again, market opens, you're monitoring the price action in the Dow, the NASDAQ, and the S&P in relation to yesterday's high and low. And then as the day unfolds, then you have reference points of today's high and low and yesterday's high and low. Are they taking those levels out at approximately the same time, or are they not? Very simple. All right, so here's what we do at those levels. Number one, all three indices are making new intraday highs or lows together. Number two, as we said already, they're making new 2-day highs or lows at the same time. So what do we do about that? You're going to monitor it. NASDAQ, S&P, and the Dow. Again, keep it the same. If you're looking at futures, use futures. If they're making new intradays at the same time, again, I put in here approximately for a very specific reason. It's not going to be exact, but you want it to be extraordinarily close. Now, the first one is when this occurs. Again, this is right into a trading strategy. When this occurs, you can expect a move of significance in that direction. Why? All the volume is on the same page. The three legs of the stool are there. You could lean on it. This means you can anticipate, again, nothing's indefinite, we're increasing the odds, anticipate squeezing more out of an existing trade or adding to an existing trade. Again, we're setting up the expectation for follow-through. So in this particular case, new intraday highs at the same time for all three indices, new 2-day highs for all three indices. You're expecting follow-through, and you should adjust your trade expectation based on the broad market scenario. The other one is divergence. The first one, number one, was confirmation. This one's divergence. Divergence is any one of the three indices. Any one, could be different from day to day, is not confirming a new 2-day high or low, or not confirming an intraday high or low that is occurring in the other two indices. It could be any one. It doesn't necessarily have to, today it could be the Dow, next week it could be the S&P. All right. Now, for example, the Dow and the S&P making new highs today, but the Nasdaq's not even close. In that particular case, what do you have? You have a sell divergence. New highs for two of them, the third one's not. We label that as a sell divergence. Now, this is a pretty bold statement here. At this point, you can expect this to be a reversal of that new high or new low. So now, again, getting into specificity, what do you do about it? Do not trade the direction of the breakout or the breakdown aggressively. Next, this is a potential change of trend for the entire market. And number 4, look for a swing point, a U-turn, which is essentially a, how would I word that, a bearish candlestick at the highs. A melted candlestick, in my vernacular, is basically a doji in the lagging market to time the reversal. So essentially what we're talking about here is look for a reversal pattern on the candlestick charts in the market that is not doing what the other two are doing to initiate the move in the opposite direction of the breakout. That's a lot to take in there, but I'm going to tell you something. When you map this out for yourself, and I purposely did not put charts in here because it's much more important for you to understand the concept and literally write down on a legal pad and then go do the work yourself and go to put the easiest way to do this. I'll give you a little heads up. Put 15-minute charts up, and if you could put up more than one chart at a time. I'll just use the indices as the ETFs, for example. The spiders, the Qs, and the diamonds. Put them all next to each other. 15-minute chart, 2-day charts, and just go back. See, at the time that 2 of them made new highs and the third one did not, pay attention to what happened after that. Do it on daily or weekly charts. If the spiders and the Dows make new highs over a 4-month window and the Nasdaq's not close, that's a divergence. If they're all doing it at the same time, you can expect follow-through. All right, so I hope this does a good job of helping you add to your argument for your stock-specific idea of how to analyze the broad-based market to understand the significance of using all 3 indices, not just one, and then more importantly, how to use that information. Have a great afternoon, everybody.